Welcome back. Fed Chairman Jerome Powell said this week the disinflationary process has begun, but we still have a long way to go, and more interest rate hikes are likely still needed. Is this the good news the markets have been waiting for? We're back now with Marko Papic. We're also joined now by Michael Craig, head of asset allocation at TD Asset Management. Great to have everyone together. I'm going to throw this to you to begin, Michael. In terms of the path that we're on, can we avoid a recession in the United States or even here at home, considering everything we've done on the rate front?
It's possible, but I would say highly unlikely. Last week, Powell came out and he kind of just said what he's always been saying, and a lot of it is we're data dependent. We don't really know. We're happy with if some of the things have played out. They're happy that goods and inflation has rolled over. And he didn't really speak out against the loosening of financial conditions with this recent equity rally. And I think equity investors took that as a cue that they weren't going to be too concerned about increased or additional Fed tightening with what's already been priced in. So markets rallied off that. I would say if you look at the official Fed communique, it was certainly not dovish or hawkish. It was kind of stay the course. And I do think that the markets are getting a little bit ahead of themselves in terms of where we stand right now.
Okay, Mark, I'm going to ask you as well, because, of course, then we heard from Jerome Powell this week in a sort of a fireside chat, sort of repeated everything he said at the rate announcement, but he had to react to that very strong U.S. jobs number and basically just said, you know what, if you continue to see a strong labor market, or maybe the terminal rate, that ending point, is a little higher. Could that tip the U.S. into recession if they need to go further?
Yes. So I definitely think that it could tip the U.S. into a recession if the Fed has to basically go away from its original plan to have a couple of more 25 basis rate hikes and then step on the pedal. And I would argue that that's right now sort of the consensus view, which is that maybe we have a 3 to 6 month pause, but then the Fed has to get meaner as the inflationary outcomes basically flatline. In other words, we get stuck at somewhere between 3.5% and 5%. And they have to go harder. And that brings maybe the inflation forward into end of the year or early 2024.
So that's provocative. I mean, that's meaner instead of leaner. And I only say leaner in the sense that at some point the market was thinking they're going to have to start cutting again, whether it's the end of this year, whether it's early next year. Is meaner a real possibility here, Michael?
Well, I think, first off, the market last week was looking for cuts next year, and I think a lot of equity investors were hoping for that. I think if the Fed actually does cut this year, it's because growth has materially rolled over and we're in some type of medium to hard recession. I think the more likely outcome is you see a few more hikes, maybe one, maybe two, maybe three, and then we're just going to stay there. We're going to stay there for a long time. And the challenge with that is that we're going to be living in an environment of incredibly restrictive policy. And over time, it will continue to cause atrophy within the economy. It will ultimately lead to moderate inflation. You are continuing seeing U.S. companies report and cut staff, cut costs, et cetera. So you're starting to see the effect of it. It's just that we're all looking for something to happen today, right? We're in this kind of social media age, instant kind of gratification. And these things do take time. I mean, there were people who were shorting U.S. housing in 2004, 4 years too early. And I think it's been a really interesting cycle in a sense that we've gone through 100% recession, soft landing, no recession, and nothing's really even happened yet. We're still very, very late cycles. So I do think the base case is restrictive policy for some time, well into 24. And ultimately, that's going to lead to some degree of economic slowdown, ultimately some reopening of the output gap.
As we await all that, and we do get impatient about wanting things to happen right now, something did happen in January. I mean, we had an equity market rally to begin the year, surprised some investors. I guess the question then becomes, where do we go from here? I'll throw that to you to start, Marko.
So, I'm not bearish because I actually don't think we get a recession in 2023. I think the way we get a recession in 2024 is if the Fed decides that flatlining at 3.5% to 4% of CPI is unacceptable. But what I think we're kind of missing is, and Michael pointed this out, which is a really important thing to point out. Many people were shorting in 2004. Eventually they were right, but they were out of a job as a professional investor for 4 years, after 4 years of basically being wrong. So why can't this cycle go on longer? Well, because we actually don't have the brain power, honestly, to wrap our minds around the amount of fiscal stimulus that remains on household balance sheets, whether it's in deposits and savings, or whether it's through the net wealth effect of an absolutely astronomical increase in real estate prices here in the US. So, people are telling me real estate prices are going to go down 20, 40%. It's not going to make a dent. When you look at a chart of overall housing equity relative to mortgage equity, we've never seen a gap like that. And so what I think the reason that's important is it means that the consumption, the C of the GDP equation, can continue to surprise to the upside and require the Fed to go much, much faster at some point. And I don't think they will do that because as CPI comes down, it's going to settle at a level where there's no political pressure by any political constituency in the United States of America, except maybe PhDs in economics, to bring us from 3.5% to 2%. So this cycle can actually potentially go a lot longer than people think.
And Marko, if that peaked out in late 2021, and we've seen a certain degree of wealth destruction in the last year, how far do you think we are from kind of pre-COVID levels in terms of that increase in real household wealth?
We've only started to dent it. I mean, you can look at how much, you're talking about peaking out in 2021, but you have to remember something from Q2 2021 until like last quarter, Q4 of 2022, we've had negative real wages. So those have actually now turned positive and inflation comes down. So consumers are not going to have to dip into their savings as much as they did over the last 5 quarters. That's one. Two, they still have more savings than they had dis-savings. And so even though people point to the fact that savings rate is coming down, they still have in their checkable deposits about $1.6 trillion that they didn't have pre-pandemic. So we're talking a gargantuan, massive amount of money that's stuck on the household balance sheet. And a lot of this is stuck in the upper income deciles, like 10 and 20%, who own most of the equities. And so they are not incentivized to really sell at all, unless we have a genuine painful recession. Now, in terms of the labor stuff, I'm looking at the same things. Most of it is concentrated in the tech sector in terms of layoffs. I think tech is definitely getting killed, and I think it's going to continue to do so. I would be bearish on tech stocks, but not necessarily the overall market.
All right, Marko, before we let you go, you've laid out your strategy very nicely as how you see perhaps this year and into next year transpiring. What is the biggest risk to what you're thinking about this environment? What could derail your thesis for this year?
I don't think it's geopolitics. I think Ukraine is on the back burner from a markets perspective, not from a objective perspective. I think China-U.S. tensions, balloons, whatever. I think the biggest issue here is the Fed. So my thesis is based on this view that we get to 3.5%, maybe even 4% CPI at some point later this year, and the Fed says we're okay with that. That's a big leap. They haven't been saying that for a very long time. And I think that's the biggest risk. The biggest risk is that Jay Powell thinks that he has to channel, Paul Volcker, even though inflation expectations are not unanchored as they were in 1979 and 1980. And that would obviously be, in my view, a policy error because he would end the cycle way too quickly for the sake of bringing CPI from 3.5% to 2%.
All right, I'm going to ask you the same question, Michael, but I'm only going to give you about a minute. Sorry to put you in a box there.
It's okay. Quickly, mild recession. But unlike our recent history, there's no kind of snapback. So it's like, really slow, anemic growth. And ultimately, that's going to be a bit of a grinder, if you will. I give on the household balance sheet, but ultimately, the Fed's going to keep hiking until they start cracking the labor market. And once that starts, it's like a freight train. And you can't stop a freight train on a dime. You can't say, well, we want to get it to 4.8%. It's not possible. So once that job market starts to roll over, whatever it's going to take, and they're going to keep going until they start to see that, it's going to be hard to slow that down. Hence, you get a bit of a mild recession, but I don't think you get the monetary stimulus to jolt us out of it.
Fascinating thoughts from both gentlemen. Our thoughts to Marko Papic, Chief Strategist at Clock Tower Group. And still ahead, Michael Craig is going to stay with us. We're going to delve into TD Asset Management's asset allocation for this year and why bonds are looking more favorable than equities. That's all ahead.